Welcome back to The Exchange. Only 40% of muni bonds were owned by individuals in the first quarter of the year. That's according to the Wall Street Journal, citing an unreleased report. And this marks a 6-point drop from 2020 as institutional investors make further inroads into this corner of the fixed income market. And analysts say increased fund ownership has been a factor in munis' recent poor performance. Joining me now to discuss is Gilbert Garcia, owner and managing partner at Garcia Hamilton Associates. I don't want to call you the bond king of Texas, Gilbert, but, if that's what everyone else wants to call you.
Like anything else, my wife always tells me, you're not the bond king at 4030 Durness Way, which is my home address.
Well, now
so she puts me in my place.
I appreciate you. You might be taking some fan mail after this. So let's talk munis. We'll make that pivot. What is going on in terms of changing ownership in the space?
Sure. But if I could step back for just 1 second, I really think it's interesting because for the first time in the last about a year and a half, we're seeing many of our institutional clients, and we're primarily institutional clients, accepted munis as an eligible asset class in their asset allocation for us. In other words, for the first time, we're starting to buy munis in our overall aggregate portfolios, even though there are no munis in the aggregate bond index.
Right.
So I think that's very telling. And I think it's a reflection of, number one, the interest differentials between munis and normal bond rates has declined. But I also think that in the last 2 years, prior to recently, you had just a lot of issuance. And I think when there's issuance, it sometimes just creates demand. Well, what we've seen, go ahead, please.
Just to be clear, though, that I'm understanding, basically what we've seen is yields rising to quite a level because people have panicked and gotten out of the space. And I have to imagine that's why institutions are interested.
Yes, but here's the thing. Up until recently, so what's happened very recently, which really only means essentially since March or so, as rates have risen, individual investors have been pulling out dramatically. You've seen sizable outflows out of the muni bond market. And over the last couple of years, we've had very stable inflows. So the outflows have been significant. And I think it's just a reflection of, number one, people are starting to get a little antsy about higher rates. I think, number two, they're very scared about inflation. And number three, I think you're starting to see a lot of things, appearing into the market that is going to start to scare people, whether it's consumer confidence at all-time lows, whether it's business optimism near all-time lows. All of those things are harbinger for what will probably be an upcoming recession.
So let me boil it down then, and it's great to have you here because you can kind of be in any of these fixed income asset classes, and our investors may be our viewers might be wondering, well, what do I do if I can now get a little bit of yield in something pretty safe like Treasuries right now? Where do you think has value, and where would you have people stay away from?
Sure. First and foremost, I really think that the Fed has been behind the curve. I think they are desperately trying to catch up. And I think out of their desperation to catch up, you're going to see, in our view, us hitting a recession somewhere near the end of the year or early in the first quarter. How deep or how shallow depends upon things they do between now and then. I think the concept of raising rates in big chunks of 75 basis points is very detrimental to the markets, especially in light of some of the things I mentioned. Consumer confidence is already low. Oil prices have already skyrocketed. All these things that traditionally has been a harbinger of a recession are already here. And you compound it with money supply, which had been dramatically off the charts in growth during COVID, has not only rolled over, it's now getting into tight areas, even tighter when you look at the high frequency data that really suggests that a recession is on the way.
Right. So point being, if you had to rank them, where do you think are the best places in fixed income for an individual investor?
Sure, I can tell you right now. Number one, I would take advantage of the higher yields that exist today. I think that we've seen either the peak of inflation or inflation is peaking. So I think this is a great time to get into the bond market, number one. And I would go into either high quality munis or I would go into U.S. Treasuries.
All right.
Because I think that we expect that as the recession becomes to appear very clearly, that you're going to see credit spreads and even the mortgage-backed securities market and other spread product widen dramatically. So I would stay away from credit. We're underweight credit. I would stay away from mortgages. We're underweight mortgages. I like Treasuries. in particular, some of the intermediate to longer treasuries. We think the curve is going to get steeper, so you'll be able to get some roll down. And I like some of the high quality munis. Munis are very interesting because if you look historically, they've had very low default rates, much lower than the credit market. So I think people are missing out if they don't look at munis at these levels.
And that's why they call you the bond king. Of your neighborhood, at least. Yeah.
Well,
Gilbert Garcia.
As long as on the bond key at my house, I'll be all right.
There you go. Great to have you on today. Thank you so much.
Thank you. Please invite me again.
We absolutely will. Consider it done. Gilbert Garcia, Garcia Hamilton and Associates.